This video is on real estate professionals. Let's start with what is a real estate professional? Well, if you're watching this video, there's one of two reasons you're watching it. One is your tax advisor is telling you maybe you should consider claiming real estate professional status, and you want to know what that means to you. What are the risks and rewards involved in doing that? Or number two, your tax advisor had you take that position and you're now under audit for it, and you're wondering, did I make a right decision in the first place, and how do I deal with this audit? Okay, that's what this video is on. Well, let me start by telling you that investing in real estate is not always the right choice to begin with. Frankly, if you're making above $150,000 a year in adjusted gross income, chances are you're going to wind up with a situation where your losses aren't allowable. Okay. Now, if you have sufficient wherewithal to invest enough proceeds in real estate so that you're not carrying a mortgage, if you could buy real estate outright and it's throwing off income, sure, it's a great investment. You can do 1031 exchanges into the next up-leg property without recognizing tax events. I really like it for that reason. If I had money, I would do that. I could tell you that about 10% of the millionaires in America were made through real estate. I like it. I would do it. The only problem is if you're a wage earner like myself, if you get paid on a W-2 like myself, there are reasons why investing in real estate to begin with may not be the right choice, and we'll get into that. So, first of all, what's a real estate professional? Well, let's start with this. Real estate by definition is passive. If you buy a piece of real estate, an apartment complex, and you rent it out and you're producing rental income and you're producing a profit, that profit by definition is passive, meaning that you don't necessarily actively participate to the point in that activity that it rises to the level of trade or business. It's more on the cusp of this is an investment on this end of the spectrum. On this end of the spectrum is a trade or business. If you have one piece of real estate, one single family residence, it's hard to argue that you're a real estate professional. But yet if you've got 58 of them and there's no management company involved and you provide all of the labor to make this go, you find all the tenants, you collect all the rent, you make all the repairs, yeah, that's going to start to look like a trade or business. I'm not saying the government won't attack you on that, but you need to understand it's a continuum, it's a judgment call, it's a facts and circumstances issue. And anytime you're dealing with a facts and circumstances issue, the government's got the upper hand. All they have to do is disagree with you. And I can tell you this, I read about 300 cases on real estate professional litigation preparing to speak on this subject, and I can tell you there's one or two winners. Almost all of the case law in this area is losers, and they're a recipe. All those existing cases are a recipe for the government to tear down your real estate professional status, which can be a disaster depending on how much you've claimed in the way of losses from real estate activity, because all of a sudden you could lose the benefit of all those losses, not just for the 3-year period of open statute of limitations, but they could go back further if they wanted to. I haven't seen that a lot. So let's get into it. As I said earlier, ordinarily, real estate activities are passive by nature, which means if you're throwing off losses from your real estate activity, as is very common, what winds up happening is that the mortgage interest and the property taxes are usually sufficient to create a situation where you've got positive cash flow coming off the activity, and because of the depreciation, which is a non-cash expense, you could be in a situation where you've got actually positive cash flow from the real estate activity, but taxable losses. And that's what really attracts a lot of people into real estate to begin with. Problem is, what you do with those losses is limited unless you can get around those rules through claiming a real estate professional. But I'm telling you here and now that that's a very dangerous thing to do, and you better make sure you've got your facts straight before you go down that road, because it'll be very expensive if it blows up on you. All right, so what is the significance of passive income or passive losses? Well, the tax code makes it so that you can only offset your passive income with passive losses. If you have passive losses from real estate, by definition, you can't take the losses from that activity and offset your active income. Well, a lot of people that find that they have money to invest in real estate in the first place are high wage earners. In other words, you're a doctor, you're a lawyer, you get paid on a W-2, you're making a lot of money, you invest in real estate. You would like to take the losses from the real estate and offset it against the high income that's generating the assets to invest in real estate in the first place. Problem is, the tax code is designed to prevent you from doing that. And let's get into it. Okay, the first carve out, which you might find beneficial, is if your income is between $100,000 and $150,000 of AGI. Okay, most people in that range, if they live very frugally, could find the money to invest in a second piece of real estate and call that rental real estate. But it's usually people making above that amount. But anyways, if you make between 100 and 150, there is a potential $25,000 offset. Even if you don't qualify for real estate professional, special carve out where you can take $25,000 worth of your passive losses from rental real estate activity and offset that against your active sources of income. However, this exemption of $25,000 phases out. For every $2 of income above $100,000, you lose $1 of the exemption. So between $100,000 and $150,000 of AGI, that $25,000 completely phases out. When you get into real estate professional status, you don't need this $25,000 special allowance to offset your active income with your passive income. By claiming that you're a real estate professional, what you're saying is, I actively participate in real estate to the point where I'm not a real estate investor. What I'm really doing is running a trader business involving real estate. When you make that argument, if you meet all the special rules surrounding real estate professional, you can take the passive losses from your rental real estate activity and offset that against the active sources of income that you're using to generate the wealth to invest in real estate in the first place. This is what makes real estate professionals so attractive, but it's also dangerous. Let's get into it. Oh, let me make one thing clear right here. California does not conform to the federal real estate professional status. In California, the most you're ever going to get is that $25,000 offset. So for federal purposes, to be considered a real estate professional, what's involved? The first requirement is that more than 50% of all the personal services that you as a taxpayer render during a taxable year must be in trades or businesses that involve performing real property trades or real property businesses that you are considered to materially participate in. That's a mouthful, and there's a lot of different hurdles that you have to meet to be considered a real estate professional. That's the first requirement. So the first thing we have to define is what are real property trades or businesses. Real property trades or businesses are those that develop, construct, acquire, convert, operate, manage, or broker real property. The second prong to this test is that you must have performed more than 750 hours of personal services during the year in real estate trades or businesses. The real advantage of real estate professional is that the hours that you put into that trade or business, if they qualify, count towards that 750 hours. Now here's the first way the IRS is going to attack you on real estate professional. For purposes of these tests, personal services performed by a taxpayer or the taxpayer's spouse do not count as services rendered as a taxpayer or an employee in a real estate trade or business unless a taxpayer owns more than 5% of the employer. What does that mean? It means if you get paid on a W-2, even though you're in a real estate trade or business, okay, a business that constructs, acquires, converts, manages, or brokers real property, that may be you may be a real estate agent, for example, but if they pay you on a W-2 and you don't own at least 5% of your employer, that time that you spend in, that 2,000 hour block of time for the year that you spend being a real estate agent does not qualify towards the 750 hour requirement to be considered a real estate professional. If it doesn't qualify, what does that mean? It means that the actual activity of managing and operating and controlling your real estate investments must come up to the 750 hours on its own, which is tough, and I'll explain why. If you've decided to claim the status of real estate professional, one of the things you need to think about is whether you're going to make a grouping election or not. A grouping election is advantageous in that what you're doing is you're saying that all of the properties that I own are really one activity, and therefore I only have to meet the material participation rules on that entire block of activity, all those properties, once. If you don't make this election, what winds up happening is that the government's going to say you have to meet the material participation tests on each property individually. Ordinarily, they'll come at you and say, I need 100 hours of personal services that qualify for real estate professional on each property that you own per year. That becomes very tough. So it's usually a slam dunk to make the grouping election. But what's the downside of a grouping election? The downside of a grouping election is that if there are suspended losses that are attached to one of your properties, those suspended losses do not become freed up when you sell one property. You have to sell all the properties that you own to free up those losses because it's viewed as one activity. This can be a real problem. So once again, the advantage of making a grouping election is that the taxpayer is going to have an easier time meeting the ownership and participation standards necessary to qualify as a real estate professional. Again, the downside is that on the other hand, the taxpayer may not be able to deduct suspended losses when one of the grouped activities is disposed of. One of the properties within the group of properties is disposed of. You would have to sell all of them, not just a single property, to release any suspended passive losses. You need to understand here that a grouping election is permanent. It's going to apply to that year and all future years unless there's a material change in your real estate operations. Guess what? Being audited and losing real estate professional status is such a change, and at that point you can ungroup or make the election to treat each property as an individual property. To make a grouping election, the taxpayer must attach a statement or declaration on the original tax return for the year that you're going to qualify as a real estate professional and make the grouping election.